Have you ever looked at a stock price and thought, wow, that's way too high for me? You're not alone. In fact, a staggering 70% of Americans feel priced out of investing in the stock market today. Yet, despite these high prices, the stock market has reached record levels, with the S&P 500 soaring more than 400% since the 2008 financial crisis. But what if I told you that this rising tide doesn't have to leave you behind? In this video, we're diving into the world of value investing, an approach that helps you uncover hidden opportunities, even when prices seem sky high. You'll learn how to spot the true worth of stocks, find underrated companies, and understand metrics that tell a better story than price alone. We'll explore why patience is key, how to build a solid portfolio without breaking the bank, and uncover strategies to find those hidden gems that everyone else is missing. By the end, you'll have the tools to navigate today's market confidently and discover if there's still value to be found. Are you ready to unlock the secrets of value investing? Let's get started. Chapter 1. The Price Illusion. Are high prices really high? When stock prices soar, it's easy to assume they're too high. But price alone doesn't tell the full story. A high stock price can mean a strong, growing company with a solid future. As Warren Buffett famously said, price is what you pay, value is what you get. Let's talk about how value investors look beyond price. They focus on what they're actually getting when they buy a stock, like a slice of the company's profits, assets, and growth. This is where the price illusion kicks in. A stock's sticker price doesn't always reflect its worth. Take Berkshire Hathaway's Class A stock. Right now, one share costs around $500,000. That's a jaw-dropper for most of us. But the price reflects Berkshire's incredible earnings and value. If we judged it only by the sticker, we'd miss out on understanding why it's still a favorite for many long-term investors. Instead of looking at just the price, smart investors use tools like the price-to-earnings (P/E) ratio. The P/E ratio compares a company's stock price to its earnings. A high price with a reasonable P/E might still be a bargain. For example, Apple's P/E is around 30 right now. That's high, but for a company with Apple's track record, it's still attractive to some. Another favorite tool? Price-to-book (P/B) ratio. The P/B ratio tells you how much you're paying for the company's assets. If a company's assets are worth more than its price, it might be a steal. Value investors like to compare these numbers to understand if they're getting real value, regardless of the high price tag. The price illusion fades when you focus on value, not price. Once you get the hang of spotting a company's intrinsic value, the numbers start to make sense. And in a market with rising prices, that's exactly what sets value investors apart. Chapter 2. Hidden Gems. Where value investors find undervalued giants. When everything looks pricey, some of the best investments are the ones nobody's talking about. These are the hidden gems. Think small or lesser-known companies in growing industries that don't make headlines. You'd be surprised how many well-known companies started this way. Let's look at data. Small-cap stocks, companies with a market cap under $2 billion, have shown solid growth over time. Historically, small-cap stocks have outperformed large caps, with an average annual return of around 11% versus large caps at 10%. And these companies often come at a much lower P/E ratio, meaning they're not hot yet. Peter Lynch, who managed the Magellan Fund to massive success, was a huge fan of finding these boring stocks. In his book One Up on Wall Street, Lynch says, the best stock to buy may be the one you already own or the one you've never heard of. Hidden gems are often in industries people overlook, like waste management, utilities, or even specialty chemicals. If they've got stable earnings and growth, they could be incredible buys. For example, consider a company like Waste Management, which was once overlooked. It's a classic example of a boring business, but one with steady cash flow and little competition. Over time, it's grown into a powerhouse. Another strategy to find hidden gems? Look overseas. International stocks, especially in emerging markets, are often undervalued because they aren't as heavily traded. The MSCI Emerging Markets Index, for example, trades at a P/E ratio much lower than the US market, making it ripe for value seekers. Hidden gems don't shine as bright at first, but for patient value investors, these companies can offer incredible long-term gains. The trick is finding stable earnings, low debt, and strong fundamentals. Hidden gems often become the giants of tomorrow, and finding them early can be a huge advantage. Chapter 3. Economic Moats. The defense against sky-high valuations. Imagine owning a company with a moat, a competitive edge that keeps rivals out and profits high. That's what Warren Buffett calls an economic moat. Moats are key for value investors, especially when stock prices are high. They make high-priced stocks more attractive because these companies have defenses that protect their growth. Moats come in many forms. Take brand value, for example. Coca-Cola has a brand that people trust worldwide. This brand moat keeps its earnings stable even in tough times. Brands that people recognize and love create a loyalty that keeps competitors at bay. Another type of moat is the network effect. Companies like Facebook and Visa benefit from the network effect. The more people use them, the more valuable they become. The S&P 500 has shown that companies with network effects tend to outperform others. Facebook, for example, has grown significantly since its IPO in 2012, even though it started with a high price. Switching costs also create moats. Companies like Microsoft and Adobe have high switching costs because their products are embedded in businesses. For many companies, moving away from Adobe's software would be costly and time-consuming. Because of these costs, customers tend to stick around, creating a predictable revenue stream for Adobe. Then there's the cost advantage. Companies with a cost advantage, like Walmart, can sell products at lower prices than their competitors. That keeps rivals out and helps them capture more of the market. Over the past decade, Walmart's consistent cost advantage has kept it at the top of the retail game, even with Amazon's rapid growth. Moats make a big difference when stock prices are high because they make growth more sustainable. A study by Morningstar found that companies with strong moats had higher returns over a 10-year period than those without them. Investing in companies with strong moats, even when prices seem high, often pays off. For value investors, spotting a moat is like finding gold. It's a sign the company can keep profits rolling in, even in a competitive market. Moats don't just protect a company, they protect your investment. If you're finding this information valuable, consider subscribing for more insights into the world of investing. Chapter 4. The Patience Premium. How waiting pays big dividends. Patience is one of the most underrated skills in investing. When prices keep going up, it's tempting to jump in. But value investors know the power of waiting. They're ready to hold off until the right moment, and that patience often leads to big rewards. As Benjamin Graham, the father of value investing, once said, the stock market is a device for transferring money from the impatient to the patient. Value investors focus on timing. Not timing the market but waiting for the right conditions. Warren Buffett is famous for sitting on billions in cash until he sees a true bargain. In 2008, when the market crashed, he put billions into companies like Goldman Sachs and General Electric. He knew that waiting for a downturn would allow him to buy great companies at low prices. Studies back up this strategy. A 2016 study from the University of California found that patient investors earned, on average, 1.5% higher annual returns than impulsive investors. The data is clear. Those who wait often come out ahead. But how do you know when to wait? A good sign is when valuations are stretched. The Shiller P/E ratio, which smooths out earnings over 10 years, is a tool value investors use to spot market highs and lows. When this ratio is high, it signals overvaluation. Right now, the Shiller P/E is around 30, well above the historical average of 16. This tells patient investors it might be time to hold off and wait for better prices. Another strategy is dollar cost averaging, DCA. This involves investing a fixed amount regularly, no matter the price. DCA reduces the impact of market highs and lows over time. By consistently investing, you end up buying more shares when prices are low, which lowers your overall cost. It's patience in action. Patience can be challenging, but for value investors, it's a golden rule. When you wait, you give yourself a chance to buy at a fair price, which boosts your returns in the long run. As they say, good things come to those who wait. Chapter 5. Beyond price. The hidden metrics value investors love. When it comes to value investing, price is just the start. Real value hunters look at hidden metrics that tell them the real story. One of their favorites? Cash flow. A company's cash flow tells you how much cash it's generating after expenses. If a company has strong cash flow, it has the money to grow, pay dividends, or buy back shares. Another powerful metric is debt to equity, DE. A high DE ratio means a company is using more debt to fund its operations, which can be risky. But companies with a low DE ratio are generally more stable. According to a 2018 study by S&P Global, companies with lower DE ratios had more stable returns over time. In value investing, less debt usually means more safety. Let's not forget the return on equity, ROE. ROE measures how effectively a company is using its assets to generate profit. It's like a test of management skill. A high ROE means management is doing a great job of turning investments into returns. In The Intelligent Investor, Benjamin Graham mentions ROE as a sign of a well-run company. Price to book, PB, is another hidden gem of a metric. The P/B ratio compares a company's stock price to its book value, which is its assets minus liabilities. Value investors love a low P/B ratio, as it can signal a company trading below its actual worth. For instance, during market downturns, some banks and energy companies have traded below their book value, offering value investors a potential bargain. Free cash flow, FCF, is another favorite for value investors. It's the cash left after a company pays for operations and capital expenses. Unlike earnings, which can be adjusted or influenced by accounting, free cash flow shows the real, spendable cash. A company with strong FCF has more flexibility and resilience. By focusing on these hidden metrics, value investors dig deeper than just the stock price. They look for signs of a company's true health and growth potential, ensuring they're buying real value, not hype. In a market filled with noise, these metrics help investors cut through and find quality. If you enjoyed this content, don't forget to subscribe for more tips and insights into successful investing.